The topic for today is the statutory liquidity ratio, which is also called the SLR. Now see, when we talk about the quantitative measures of monetary policy, we have these 4 points. The first is the bank rate, open market operation, cash reserve ratio, and the statutory liquidity ratio. Of the 3 above topics have been discussed in separate articles. Today, we shall focus on the statutory liquidity ratio. Let's begin. Now, what is the meaning of this SLR? SLR is the minimum percentage of its total deposits of a commercial bank that each and every commercial bank has to maintain in the form of cash, liquid assets, gold, and other securities. So now listen carefully. We begin with, it is the minimum percentage of its total deposits, right? Now, whatever deposits of commercial banks are there, we will be discussing the percentage of their deposits, whatever they have. If they have total deposits of rupees 100, right, and the minimum percentage can be 10%, so it comes out to be rupees 10. So it is the minimum percentage of the total deposits. We shall consider the total deposits of the commercial bank, right? A fixed percentage will be used for that of each and every commercial bank, which it has to maintain. It is mandatory that it has to maintain that particular percentage of the total deposits in the form of cash, liquid assets, gold, and other securities. That percentage, which will be fixed for you, for the commercial bank, it has to maintain in these 4 forms, either in cash, liquid assets, gold, and other securities. Clear? SLR is that reserve requirement of the banks that banks are expected to maintain before they offer credit to the customers. Now, before lending, you have to keep it as a reserve. That is called the statutory liquidity ratio. It will be the minimum percentage of the total deposits, which should be made it clear to each and every commercial bank, and it has to maintain the liquid assets. SLR is a traditional tool of the central bank. It is in addition to the mandatory cash reserve ratio. So we know that every commercial bank has to maintain the cash reserve ratio. This SLR is in addition to that, so you have to do it only. Cash reserve ratio, so you have to keep. In addition, this statutory liquidity ratio is also must for every commercial bank. So I repeat, first of all, you calculate the total deposits of a commercial bank, then the minimum percentage you will calculate, and what answer comes, that figure has to be kept in the form of cash, liquid assets, gold, and other securities. Now, I use the term liquid assets. What is the meaning? These are the assets which are easily convertible to cash. It's very simple, liquid assets. These include, in the case of SLR, they include gold, treasury bills, government approved securities, cash reserves, and the government bonds. So when we discuss cash reserve ratio, we used to focus that the cash has to be kept of this percentage. Here in SLR, cash is not mandatory. Liquid asset, the term we will be using liquid asset, it will be including this gold, treasury bills, government approved securities, government bonds, and the cash reserves. Now, liquid asset term also includes the securities which are eligible under market stabilization schemes and market borrowing programs. These securities can also be counted as liquid assets to maintain statutory liquidity ratio. Now, the question, has SLR to be reserved with RBI? No, SLR is not to be reserved with RBI. SLR has to be kept with the banks themselves. We know that when we discussed cash reserve ratio, the term was used to deposit it with the central bank. CRR is to be deposited with the RBI. But SLR is not to be parked with RBI. It has to be kept in every bank's own vault. This is the condition that you have to maintain that liquidity ratio, that statutory liquidity ratio, but this is not to be kept with central bank. You have to keep that with yourself. Every bank has to keep it with itself. Deposits are to be maintained by the banks themselves and not with RBI. Okay, the banks keep SLR in the form of government securities as it will earn them interest as its income. Now see, whatever the commercial banks, they will be investing in government securities for maintaining the mandatory statutory liquidity ratio. Those government securities will be earning interest, and that will be the income of that commercial bank. Clear? Next. See, Section 24, subsection 2A and Section 56 of the Banking Regulation Act 1959 makes it mandatory for all the scheduled commercial banks to maintain SLR. Now, for which all financial institutions is SLR compulsory? A, all the scheduled commercial banks. B, for all the primary urban cooperative banks. We call them UCB. They also have to maintain SLR. For all the local area banks, for all the state cooperative banks, and for all the central cooperative banks. So this whole category has to maintain SLR. It is mandatory, fixed by the RBI. You have to do this. Okay. Now, the rate of SLR is to be decided by the Reserve Bank of India. It will be a unique rate. It can be changed. It is just the authority of the central bank to change it. What percentage it needs to be fixed, it will fix it, and it will be similar for all the banks. Okay. Now, the upper limit of SLR is 40% and the lower limit of SLR is 23%. So, the range of SLR can vary from 23 to 40% depending upon the discretion of the Reserve Bank of India. SLR is computed as a fixed percentage of the bank's NDTL. As I told you in the first slide, it is the minimum fixed percentage which of your total deposits. Now, what is the meaning of NDTL? It is the total net demand and time liabilities. What is the meaning of demand liabilities? All such liabilities which the banks have to pay on the demand of the customers. These are current deposits and demand drafts. Supposingly, I open a deposit in a bank and it's my current deposit. Now, it is upon my will. Whenever I want to go, I can withdraw the cash. Okay, so that will be termed as the demand liabilities for the commercial bank. Then there are the time liabilities. Time deposits, those liabilities of the banks which are to be repaid on the maturity date. The customers have to wait for the due date to withdraw. Now, supposingly, I open a fixed deposit in the commercial bank. Say it is for a period of 2 years. It can be for a period of 5 years. So, I have to wait for that 2-year or 5-year period to go and withdraw my money. So, my money can't be withdrawn before that maturity date. So, such types are called the time deposits. Now, coming to our point of SLR, you will take the total of the demand liabilities and the time liabilities, banks NDTL, you will calculate. Now, on this, you will be given a fixed percentage by the RBI. RBI will finalize a percentage and that will be your SLR. Quite simple, right? Next. Now, what is the formula? There's a very simple basic formula. It will be the liquid assets divided by the time demand liabilities multiplied by 100. This is a simple figure to calculate SLR. Let us take a case of KMT Bank. KMT Bank has 4 crore as liquid assets and it has 40 crores as NDTL. Now, SLR is liquid assets upon time and demand liabilities multiplied by 100. So, in this particular case, you will have 4 crores divided by 40 crores into 100, which will give you 10%. Now, the current SLR rate according to RBI for the financial year 2021-2022 is 18%. Okay, this is the current slab. Now, SLR, it gives flexibility to the lending operations of the banks. How does it provide? Let's see. To reduce the flow of credit in the economy, the central bank increases the SLR. Listen carefully. Now, the central bank, if it wants to reduce the flow of credit, it does not want that the banks should have more loanable funds. So, what will it do? It will increase the SLR. When the increase in SLR will take place, there will be a reduction of loanable funds which will be available to the commercial banks. So they will not be able to give more and more credit to the general public. So this will reduce the flow of credit in the economy. I repeat, when the SLR increases, the flow of credit in the country reduces. Now, increased SLR controls inflation. An increased SLR actually will reduce the capacity of the banks to inject more money into the country. Very simple. SLR increases, loanable funds decreases, less funds will be available to the general public, and therefore less money will be injected into the country and you will be able to control inflation. This is how RBI uses the tool of SLR to control inflation. What will it do to control inflation? It will increase SLR. Okay, now the second portion is to increase the flow of credit in the economy, central bank reduces the SLR. When statutory liquidity ratio will decrease, there will be more loanable funds available for the commercial banks to grant loans to the general public. When general public will be getting more loans, the flow of credit in the country will increase. Okay. Decreased SLR will allow banks to inject more money into the country. Decreased SLR shall cause growth in the country. How come? Because when there will be more loanable funds, more general public will be getting loans. So there will be more investment. More investment means more growth. Okay. So this portion and this portion is just the opposite. Please don't get confused. Right? Next. Now, what are the objectives of SLR? With SLR, RBI exercises the control on the amount of money supply in the country. As I always say, that the magic wand lies with the RBI. It exercises its control. What does it want to do for the money supply? It wants to increase the amount of money supply. It can do it very well. If it wants to reduce the money supply in the country, RBI can do it very well. The tool here discussion is statutory liquidity ratio. RBI exercises the control over the flow of bank credit in the country with SLR. As I just told you, RBI increases SLR to reduce the flow of bank credit in the country at the time of inflation. RBI reduces SLR to increase the flow of bank credit in the country at the time of recession. If it wants to reduce the flow of bank credit, it will increase SLR. And if it wants to increase the flow of bank credit, it will reduce SLR. So this portion takes place at the inflation time and this portion takes place at the recession time. Further, by making SLR mandatory to the commercial banks, the RBI or the central bank forces the commercial banks to invest in the government securities. Now see, this is a very big advantage of the statutory liquidity ratio, that making it mandatory, all the commercial banks, they have to invest in the government securities. You know, sometimes you are not willing to do a particular task, but because it is the mandatory, it is necessary, compulsory for you, you have to do it. And then later on you realize that, okay, this is nice. But here, because it is made mandatory by the central authority, so all the commercial banks, they have to invest in the government securities. RBI ensures the solvency of the commercial banks through statutory liquidity ratio. Another advantage is the solvency of the commercial banks is very well maintained. Further, SLR helps to guide the financial policy of the economy. It's a very important quantitative measure of monetary policy. And the financial policy is framed by taking the help of statutory liquidity ratio. See, SLR behaves as the reference rate to help RBI in fixing the base rate. Now, RBI has to fix the base rate, right? How will it do it? It will keep SLR in mind as the reference. Now, what is the base rate? Base rate is the minimum lending rate. Below this basic base rate, lending is not allowed for any commercial bank. So, to fix the base rate, RBI takes the help from the statutory liquidity ratio, which behaves as the reference rate to help RBI. Right? Now comes the points of difference between statutory liquidity ratio and the cash reserve ratio. See, the first point, the liquid assets and the securities which are to be maintained have to be kept with the particular bank itself in its own vault. Okay. But here, the cash reserve which is to be maintained, it has to be kept with RBI. Banks don't keep it with themselves. Very simple point. This you have to keep it with yourself. This you have to keep it with Reserve Bank. Second point of difference, the banks are required to have the reserves of liquid assets, cash, gold, government securities. Here in CRR, the banks are required to have only and only cash reserves. No gold, no government securities, nothing doing of that sort. So this is the second point of difference. And the third point of difference, banks earn returns on the money kept as SLR. You earn interest there. Here, banks earn no return, no interest on the money kept as CRR. Although the cash reserves and the cash reserve ratio is to be deposited with the RBI, but still RBI will not pay any rate of interest on the said amount. So in this SLR, banks earn returns. Here they don't earn any interest, any return on the cash reserve ratio. So here we come to the end of the article. I hope I have made the things very clear. In case you have any doubts, feel free to ask in the comment section. Please subscribe to my channel. Thanks for watching. Stay safe, stay blessed.